So with that, let's jump in to the questions. What do we have up first?
Looks like a question just came in. A client wants to know, what's your favorite way to help a client lower taxes without touching payroll or retirement?
Without touching payroll or retirement. So is this
Yes.
like somebody who owns their own business?
Yep.
Okay. So the
S corp.
payroll, yeah, the payroll and retirement is actually the last thing that we do because the payroll really, when you really want to optimize it, it really depends on everything else that came before because it's going to be an adjustment compared to the net taxable income. So all the things we do beforehand is really what we do a lot of. So, entity structuring is number one always. From there, we move into uh, reimbursement plans of various stripes. There's accountables, there's MERPs, there's Section 127 plans, all this kind of stuff. The summit strategy session would be next, and all of those are going to reduce taxable income, and that's the favorite stuff to do first. And then from there, it's going to depend on what's going on. So, client I was just working on before the show started, she had a 2023 filing as an S corporation, and she was asking if there was anything to do. So at first glance, I said probably not. There was income and there was expense and everything, but then I was reading through the tax return. And I was like, oh, there's a commercial van that was purchased, and what happened was that the other tax preparer, whoever prepared it, had listed it as a passenger vehicle. So if you're a passenger vehicle under 6,000 pounds, it's one set of rules. If it's a commercial vehicle over 6,000 pounds, different set of rules. And so, when I went through the analysis of this, this was an expensive commercial vehicle, and we're able to create a swing in the taxable income from positive 87,000 to minus 17,000. So it was a big swing, about $104,000 swing in taxable income just from that one change by recognizing what different rules apply to this asset. Now, obviously, that's a case by case basis. Not everybody has that every year, but when things do come up like that, then we like to take advantage of the rules and in the most advantageous way possible. So those are fun ones. All right, what's next?
Yeah, so we got a question from one of our client boss. So he asked, how much can we pay a kid without needing to file a W-2?
None. You got to file a W-2.
Yeah.
So without paying taxes is a different question. So if you set it up right and you put your kids on payroll, you have to give them a W-2. That's just it. Now, if the taxable income is less than the standard deduction, you can skip the tax return because you don't have a filing. So in 2025, the standard deduction for a single person is $15,000. So if you've got W-2s of $12,000, just as a number, then technically you don't have to file. Now, if there's withholding, you should because you're going to get that money back. If you have non-W-2 income for that same person, then you should probably still file because if there's investment income, weird things can happen with kitty tax and all those kind of things. Generally, encourage avoiding that. There's also a secondary consideration that if you go for college financing, if you have an UTMA or if the kid has assets in their own name, like a stock account or something, then that counts against them for financial aid purposes. But if it's in the parent's name, it doesn't. So interesting things that happen. So yeah, so you still have to file W-2, assuming that they're on payroll. But whether you file the tax return or not is optional. If you have an older kid who's doing more work and you're playing either the 401k game or the IRA game, a lot of times you can end up paying more than the $15,000. But then when it comes down to the taxable income after the adjustment for those retirement contributions, then you're under and you're still tax free. But in that case, you would still need to pay, or you would still need to file a 1040 to demonstrate all those things that happened. So if a kid has a W-2 of 20,000 and then puts 7,000 into a traditional IRA, now their taxable is 13, and that's under the standard deduction, no tax, but you do have to file just to show what happened. But yeah, the short answer is if a kid is earning money from a company, you have to file W-2.
Alrighty. Looks like we have another question coming in.